Looking for the best e-commerce stocks to add to your portfolio? You've come to the right place. The sector is more dynamic than ever, and knowing which companies have the strongest growth prospects is key. In this video, we'll give you a clear breakdown of our top picks. We're talking company fundamentals, market positioning, and of course, the crucial analyst ratings and price targets you need to watch. Get your watch list ready, and let's begin. Shopify Inc., ticker SHOP. Shopify is a leading global commerce company that provides a multi-tenant, cloud-based platform for businesses of all sizes to create, manage, and scale their online stores and retail point-of-sale systems. Its comprehensive suite of services includes tools for payments, marketing, shipping, and customer engagement, effectively simplifying the complexity of running an e-commerce business. By serving as a critical operating system for internet merchants, Shopify generates revenue primarily through subscription fees from its various plans and through merchant solutions, which include payment processing fees and shipping services. The company empowers entrepreneurs and established brands alike to sell directly to consumers across various sales channels, from web and mobile to social media and physical locations. If you've been watching the stock market in 2025, you've seen one name consistently making waves: Shopify. This e-commerce giant has not only recovered but has been absolutely on fire, with its stock price more than doubling in the last year. But after such a massive run-up, the million-dollar question is it too late to buy in, or does Shopify still have room to grow? First, let's talk about the raw numbers. As of late October 2025, Shopify is trading at around $173 per share, giving it a massive market cap of $225 billion. Now, here's the figure that many investors pause. Its P/E ratio is 96. That is expensive. It means the market is pricing in absolutely stellar growth for years to come. So, is the company delivering on that promise? The short answer is yes, it absolutely is. Let's look at their latest report card. In the second quarter of 2025, Shopify posted 31% revenue growth. Even more impressive, this marked their 8th straight quarter of double-digit free cash flow margins, coming in at 16%. This isn't a company just growing for growth's sake. It's a company that has successfully pivoted to profitable growth. In Q1, they grew revenue by 27% to $2.4 billion. And the total gross merchandise volume flowing through their platform hit a staggering $74.8 billion. The bottom line? A net income of $906 million. This is a clear sign that management's shift from growth at all costs to operational efficiency is paying off in a huge way. So what's fueling this growth? It's not just about providing an online store anymore. Shopify's real strength lies in its powerful ecosystem. Think about Shop Pay, which speeds up checkout, or the Shop app, which keeps customers engaged. The more merchants they have, the more valuable this ecosystem becomes. That's a powerful network effect. And they're not standing still. Their big bets for the future are in 3 key areas: artificial intelligence, tools like Shopify Magic, or using AI to help merchants with everything from marketing automation to product descriptions. Global expansion. They're seeing massive GMV growth in Europe and Asia Pacific, showing this isn't just a North American story. And B2B and omnichannel. They're building tools that let merchants seamlessly sell to other businesses and integrate their online and physical stores. Because of this strong execution, most analysts maintain a buy rating on the stock, seeing it as a long-term winner in the global shift to digital commerce. Now we have to talk about the risks, and they are significant. The most obvious one is that sky-high valuation. Trading at 18 to 19 times sales, Shopify has to execute perfectly. Any stumble, any missed quarter, and that premium price tag could get a brutal reassessment from the market. Then there's the competition. Amazon, with its Buy with Prime program, is coming for their merchants. Platforms like Wix and Square are constantly improving. Shopify cannot afford to be complacent. Finally, they're exposed to the global economy. If consumer spending slows down, or if small businesses, their core customers, start to struggle, their GMV growth will feel the impact.
The analyst community is overwhelmingly positive on Shopify. The consensus rating from over 30 analysts covering the stock is a solid buy or moderate buy. When you look at the individual ratings, you see a sea of strong buy and buy recommendations, with very few, if any, sell ratings. This tells us one thing clearly: the professional investing world still believes in Shopify's long-term story. Here's the paradox that every investor needs to understand. While the rating is buy, the average analyst price target is around $143. Let me repeat that. The average price target is 17% below the current stock price. This is the market's way of saying, we love this company, but at this price, we're getting cautious. The massive run-up has pushed Shopify's valuation to premium levels. Analysts are flagging that while the business is strong, the stock might be a bit ahead of itself in the near term. They also mention macroeconomic risks, like changes in consumer spending, that could affect all high-growth stocks. The analyst community is essentially presenting Shopify as a high-conviction, long-term buy, but with a warning about near-term volatility. Here's how to think about it. If you're a long-term investor who believes in the future of e-commerce and Shopify's dominant platform, the overall buy consensus is very encouraging. Many analysts still see this as a buying opportunity for those with a multi-year horizon, expecting that growth will eventually justify and surpass the current valuation. However, if you're looking for a short-term gain, the risk is higher. The low average price target suggests analysts see limited upside or even a potential pullback from these elevated levels.
Alibaba Group Holding Limited, ticker BABA. Alibaba Group is a leading Chinese multinational technology company specializing in e-commerce, retail, internet, and technology. Founded in 1999 by Jack Ma, its core business operates a vast portfolio of platforms that connect merchants and consumers, primarily through its landmark online marketplaces, Taobao, consumer to consumer, and Tmall, business to consumer. Beyond domestic e-commerce, Alibaba's ecosystem extends to international commerce, AliExpress, Lazada, cloud computing and data intelligence, Alibaba Cloud, digital media and entertainment, logistics, Kaineo Network, and innovative financial services through its affiliate Ant Group. The company's mission is to make it easy to do business anywhere by acting as an intermediary, providing the infrastructure and technology to facilitate commerce and services for millions of businesses and consumers globally. Is this Chinese e-commerce giant a hidden gem trading at a reasonable valuation, or is it a value trap weighed down by too many risks? Let's start with the basics. As of late October 2025, Alibaba stock is trading around $174, giving it a massive market cap of over $405 billion. Now here's the first thing that catches the eye of value investors: its valuation. With a P/E ratio of 19.7 and an EPS of 8.87, it looks reasonably priced, especially when you consider its size and growth. So what's driving the optimism? First, financial strength. In their last fiscal year, Alibaba grew revenue by 6% to $138 billion. But more impressively, operating income surged by 24%. This shows they're not just growing top-line revenue, they're getting more efficient and profitable. They're also putting their money where their mouth is, returning billions to shareholders through a $4.6 billion dividend and aggressively buying back shares. Second, and this is crucial, growth engines beyond e-commerce. While Taobao and Tmall are the well-known cash cows, the real excitement is in AI and cloud. Alibaba's cloud revenue has been growing at triple-digit rates consecutively. This isn't just a side project, it's becoming a core driver of their future and a key technological edge. Third, strategic expansion. They're pushing into new areas like quick commerce with services like Shangguo and leveraging their huge ecosystem like the 88 VIP membership to lock in customer loyalty.
Now let's flip the coin. You can't talk about Alibaba without addressing the very real challenges: The biggest overhang is, without a doubt, regulation. The scrutiny from Chinese authorities remains a persistent risk that can create uncertainty and volatility. Then there's fierce competition. They're battling on all fronts, in e-commerce, in the cloud, and in AI, both at home in China and globally. And not all divisions are profitable. Their food delivery service, for instance, has been reporting substantial losses, which can drag on the company's overall profitability. Finally, we have the geopolitical wild card. Tensions between the U.S. and China can always flare up, potentially creating trade barriers or other headwinds for U.S.-listed Chinese stock like BABA. The message from Wall Street is overwhelmingly positive. Out of 19 analysts covering the stock, a whopping 17 have a buy rating, and one even has a strong buy. Only a single analyst is currently recommending a sell. That's a solid 95% of analysts telling you to either buy or hold this stock. The average 12-month price target sitting at around $190. From the current price near $175, that implies a nearly 9% upside potential. But some major banks are far more bullish. Firms like Jefferies and Bank of America have price targets as high as $230 and $245. The analyst community largely favors Alibaba as a buy. They see a company in the midst of a powerful turnaround, driven by its cloud and AI divisions, with a clear path for continued share price appreciation. While you should always be aware of the risks, the data suggests that for those with a tolerance for some volatility, BABA could still be a compelling addition to a growth portfolio.
Mercado Libre Inc., ticker MELI. Mercado Libre is a leading Latin American e-commerce and fintech ecosystem, often referred to as the Amazon of Latin America. Founded in 1999 and headquartered in Buenos Aires, Argentina, the company operates an integrated business model centered around its online marketplace, which connects a vast network of buyers and sellers across 18 countries, including key markets like Brazil, Argentina, and Mexico. Beyond its core e-commerce platform, Mercado Libre has aggressively expanded into financial services with its Mercado Pago digital payment solution, which facilitates transactions both on and off its marketplace. This is complemented by Mercado Fondo, an asset management service, and Mercado Crédito, which provides loans to sellers and buyers. To support its logistics and fulfillment needs, the company developed Mercado Envíos, a comprehensive warehousing and shipping network. This synergistic approach, combining commerce, finance, and logistics, has solidified Mercado Libre's position as a dominant and indispensable technology company driving digital transformation throughout the region. Mercado Libre isn't just growing, it's on fire. The company is projecting revenues of around $28 billion for 2025. That's a staggering 35% year-over-year growth. Its earnings per share are a robust 40.4, and it just posted a record $825 million in operating income in a single quarter. But here's the catch you've probably spotted: the valuation. With a P/E ratio north of 53, this stock is not cheap. The market is pricing in perfection, and so far Mercado Libre is delivering. How? The secret sauce is its fintech arm, Mercado Pago. Think of Mercado Libre as an ecosystem, not just a marketplace. While e-commerce is the foundation, Mercado Pago is the rocket fuel. It has 68 million monthly active users. Its credit portfolio has exploded, growing 91% year-over-year to over $9 billion. And crucially, they're managing this growth responsibly, with non-performing loans actually decreasing. This creates a powerful loop. Someone uses Mercado Pago to pay for a purchase, gets offered credit, uses that credit to buy more, and sees targeted ads on the platform. This super app ecosystem locks in users and creates incredible lifetime value. Speaking of ads, their advertising revenue jumped 38%, showing they're effectively monetizing their traffic.
So where does the growth come from next? Market dominance in Brazil. Key partnerships, like with retailer Casas Bahia, are expanding their reach in their largest market. The Latin American digital boom.
The entire region is still in the early innings of digital adoption for commerce, payments, and lending. Mercado Libre is the best-positioned player to capture this decades-long trend. Advertising and logistics. These high-margin businesses are becoming significant profit drivers, diversifying their income beyond simple transactions. Now, let's pivot to the risks. This is not a smooth sail, and ignoring these would be irresponsible. Competition. They're fighting a war on two fronts, against global giants like Amazon and See's Shopee in e-commerce, and against a flood of local fintech challengers. Economic volatility. This is a huge one. Operating in Latin America means navigating inflation and currency chaos, especially in countries like Argentina. This can hurt consumer demand and create credit risks. Costs and regulation. Rising logistics costs are squeezing margins, and as their fintech business grows, so does the scrutiny from regulators, which could lead to higher compliance costs. The analyst verdict on Mercado Libre is a resounding strong buy. Here's what that looks like by the numbers. Among the 18 analysts covering the stock, a massive 88% are telling you to buy. That's a combination of 50% recommending a strong buy and 38% recommending a buy. The remaining 13% advise a hold. And crucially, 0 analysts have a sell rating. That's a powerful signal of confidence from the pros.
The upside potential is where things get really interesting. The average 12-month price target for MALI sits at approximately $2,799. With the stock trading around $2,160, that implies a potential upside of about 30% from current levels. And this isn't just a vague average. Some of the biggest names on Wall Street are backing this view. Firms like Benchmark, Barclays, Citigroup, and JP Morgan all have buy or equivalent ratings, with price targets ranging from a solid $2,600 all the way up to $3,000 and beyond. There's also one conflicting data point to note. Zacks currently has a number 4 sell rank on the stock, primarily due to recent earnings estimate revisions. This highlights that while the long-term story is strong, there can be short-term turbulence. But for most analysts, these concerns are outweighed by the colossal growth story. In fact, the smart money is putting its cash where its mouth is. Institutional investors like Rational Advisors have recently been boosting their positions in MELI, a strong vote of confidence. The analyst consensus is clear. Mercado Libre is considered a core growth stock for capturing the Latin American digital revolution. The strong buy rating and significant upside potential reflect a belief that the company's strengths in e-commerce and fintech will continue to drive value. While you should be aware of its rich valuation and the potential for short-term volatility, the overwhelming expert opinion is that any dip could be a buying opportunity. Do you own MELI, or are you considering it? Let us know in the comments below. Thanks for watching.